Thank you very much, Kathy, for the chance to talk to your group today. Kathy did share with me some of the incoming concerns about what's been going on with the market recently here, and I would like to attempt to respond to them in a concise manner. See if you folks have any questions or comments that you'd like to make. First, I'd like to address the comment of why the market has been going down so much, so fast and so hard. And of course, the market has been enjoying a very strong bull run. It's been very, very strong since really, particularly since the beginning of last October, almost up in a straight line, 17% up, almost in a straight line. And it was poised to come down. But beyond that, we're encountering this virus and the effects of it in the U.S. and around the world. And the market's trying to get a handle on it. Our businesses and economies are trying to get a handle on it. And one thing that the stock market really does not like at all is uncertainty. And we've got a lot of uncertainty going on right now. The market will sell first, generally, and ask questions later. So it will often, pretty much always, act in advance of the information that we have. I was noticing, I think Kathy mentioned the president was on just now. The president is attempting now to get on with the American public, perhaps on a daily basis more often. That brings more confidence, more comfort to people, to the markets. I noticed that since I left it, until I left it to try to give a call in here, since the conference began, his press conference began, the market was up about 8% from that moment. So the market has had a pretty strong day today after yesterday's just horrible day. And I would like to address first what is going on in the stock market, followed by what the leading factor is for why it's behaving this way, what we might expect from the economy, and then what we really need for this all to work out very well, and quite possibly beginning maybe in the third quarter. It all depends on how well this all plays out. But for right now, yesterday was a fairly unprecedented day, nearly unprecedented in the market. The stock market was, whether you look at the Dow or the S&P 500, was down about 10%. There's nowhere to hide yesterday. There was nothing that you could own, really, that would have missed the carnage. You would think on a day that was filled with fear, gold would go up. It's supposed to go up when there's fear. You would think that treasury bonds would go up in price, but actually they did not. This was a day of what we call capitulation, where people in the marketplace were behaving not rationally, but behaving with fear. Just sell whatever I have and put me into cash. I am so afraid because it went down so much and so fast. This was the second worst down day by a particular day in our stock market history, at least. Going back to 1987 was the worst. I don't know how many of you recall the big bear market in 1987. It was, I believe, October 19th. I was there. I was much younger then. The stock market fell over 20% on one single day, and we were all shell-shocked. But here's the thing about the market. No matter the market behavior on any particular day or short period of time, at the end of it all, the valuation of the market is a reflection of the earnings of the companies in America. And as a forecasting mechanism, the market moves in advance. It tries to figure out what the next 6 to 8 months hold. The market goes down very hard, as it has done in recent days here, from record highs just a week ago, Wednesday. It is a reflection of the market concerned that events will lead to a recession. The market just does not like a recession. What happened in 1987 was that the big pullback, for whatever reason it occurred, did not result in a recession, so that within 18 months of the worst down day in the history of the stock market, you are at new all-time record highs in the stock market. So we in our business, I know Kathy and her team are this way for you. We are meant to be students of the market, professionals. We study history. We do not let our emotions get to us. Unfortunately, a lot of investors do. And a lot of investors in what has been a very strong bull market here since it began way back in 2009, We're beginning to feel very complacent. This is easy. I can manage my own money. I can just continue to buy whatever it is they're buying. And then fear strikes and everybody wants out at once. This is how you get down days like this. Now the dust settles and we say, all right, I, as a professional in this business, as a market strategist, am interested in what value the market ought to be based on corporate earnings. And what is the pullback in the stock market to yesterday? S&P 2492 was a 27% decline from an all-time record high, which was achieved just within the last week or so. What is it reflecting? It is reflecting corporate earnings, which would be down 15 to 20%. That is a recession. Right now, the stock market is pricing in a recession. Will we go into one or not? We're not sure, but we do know that every piece of economic statistics, just about, that we have gotten up until this virus hit has shown a very strong USA, very strong corporate earnings, very, very strong consumer. Consumer is fully employed. We have more Americans today working than ever before. The consumer has been out there and doing their shopping chores. And then we got hit with this virus. I want to tell you something that I think people need to understand, which is that because today, computer-based trading, you may be aware, computer-based trading, algorithmic trading is a big feature of the market. You are likely to see more volatility than maybe we are used to seeing. That does not mean we should not be afraid of that. We really should not be watching our screens all the time. But it means that you're likely to see on big down days more fear. Today we're up 8%. Am I happy about that? It's good to have an up day, but it is no more normal to have an up 8% day than a down 8% day. These are volatile markets, which means we're not probably going back to clear sailing for a while, but we are more interested in the market that it should, if once it gets hit hard, it should bounce. We bounced today. Will we bounce into the next week? Well, let's see what the news occurs over the next week. But historically, when you have been hit as hard as we have in a short period of time, you need to bounce around the lows several times. You need to go up and down and up and down. It usually takes about 4 to 7 months to really flesh this all out, where the market sees actually there's progress being made on the virus. We're not seeing a recession. Hopefully, we're not seeing people get laid off. Last numbers on jobs growth are fantastic. We need to watch and see this. What's the leading reason for this big pullback? Is it oil or the virus? It's absolutely the virus, because the virus all around the globe, starting with China, and how very contagious this virus is, even though it's like a cold or a flu to 80+% of the people. It's very, very scary to a lot of people, and we don't have a vaccine for it yet. So it's got people really holding in, as you know, social distancing, as you know. The problems with the price of oil is just, unfortunately, insult on top of injury. But I think oil in general, though it can move markets, not nearly as important to our economy as it has been historically. And we can talk about that in question and answers, if you will. What will be the duration of this event? Of course, no one knows. We've gotten great news, we think, out of China, which was the beginning of this whole problem. China was very quick to tell their people, go home, self-quarantine. Now they're coming back to work, and we're getting evidence, lots of evidence that we're gathering that shows people appear to be going back to work. Production appears to be coming on board. That's one test case. As you know, the next big one was Italy. Italy got hit hard, probably having a lot to do with the fact that they were not aware that they maybe needed to watch their borders and make sure people who were infected did not come in. They've got a very old population there in general, as you know, and so they've been hit hard. USA, we're a huge country. We're just starting to see how this will play out. I personally believe that we will all watch, particularly for the United States, yes, China, yes, Italy, but for the United States to have their number of cases peak and start to come down again. And that will be the beginning of the end. And the thing about the market is it will not wait for the end. It will react, and very well could react quickly and in what we would like to think of as a strong V-shaped recovery. And the chance for a V-shaped recovery in businesses, people going back, starting up, maybe we won't get March Madness. Maybe we'll get April Madness. Who knows? Maybe May Madness. I hope we can get some good madness here, and other sports, etc. Maybe we can get that back to the extent we can, get people back and out again. We will avoid the recession. And that's what we don't know. That's what we need to monitor. But the great news for the United States of America is if we had to have a global virus like this, the United States of America is the strongest country in the world. We are fully employed. We have the best resources in the world to go after this. And there is finally, it looks like, as we are watching our policymakers, they're starting to really get after this. And if you didn't see the press conference today, you were dialing in, can check back with it. They're really going after this with all the might that they can of the professionals to see this would peak out. But I feel good because the United States is no longer as much a manufacturing country as it is a services-based country. So very much probably easier to get back online from slowdowns that we have had. This is the great news that I want to that I really want to emphasize. We have a lot of baby boomers. I'm one. I feel very, very good. I'm not in my 70s yet. I don't have any problems, no health problems, but we are blessed in the United States with lots and lots and lots of millennials, and then the next younger generation, Gen Z. These people are young, they're healthy, they're fully employed, they're in a good mood, and they want to go out. They want to enjoy St. Patrick's Day. They're not pleased at all about the hockey games being suspended for a while, and they are going to get bored. And this cannot last, in my view, for too long, all this closure. But you've never seen before the shutdown of so many things outside of war. This again leads to uncertainty, which will affect the market. But I think that our consumers, again, if you get hit with this virus and you're not in that small group of people, you may not even know you have it. You may have cold symptoms, but we're self-containing now because it's so contagious. Otherwise, we're feeling good. It's starting to look sunny outside. It's starting to get warmer. And that's good news for this to potentially go on further. What do we really need? And here's what the market is looking for. This is the confidence that we are looking for. We need three things. Number one, we need lots and lots of test kits, and we need them in a lot of places. One of the reasons the market turned around today is they're starting to have these tents now in more and more cities. They'll go up as fast as they can. So you can take a test, your loved ones can, and say, you know what? I'm good. I don't need to stay home even if I've been coughing. We need, as I said earlier, to see evidence that we have seen a peak in the number of cases, and we need big fiscal policy. Whatever we start to hear, this is a little problem. We're in the middle of an election year. The Democrats don't want to help Trump, but the Democrats, nor do the Republicans want to be seen as anyone who would slow down what could be a recovery that is needed, particularly with the people out there who are laid off because their businesses are shutting down for a spell. It's not their fault. Maybe of the lower quartile of income, maybe small businesses that really need the credit lines to continue on for them to make themselves through this rough patch. We need to see that sort of fiscal policy, big fiscal policy, another interest rate cut by our central bank, that type of thing. We need to see it around the world, and we're starting to see that. So some of what we need is starting to come through. That's good news. My final comments to you, with much thanks to Kathy, the chance to talk to the group this day. What should we do with our portfolios? You know, as Kathy said, no one not even the best market professional can time the stock market. You get hit hard and fast like this, the last thing you want to do is panic and sell. And of course, whatever anyone's risk tolerance is, that's why you have Kathy. She knows each person, each of her clients individually. what your station in life is, what you need for cushion, what your willingness is to take on these big hits. But history is very clear, and I think Kathy made some comments early on about other times and when you've had pandemics or health crises. There was a big swine flu. It was a huge deal in America. Nobody can possibly remember that anymore. It becomes a distant memory. If we are, as we should be, long-term investors, we should not react. We should not react we should not panic. What to do to minimize loss? And again, we could be moving into an economic slowdown. We could be moving into recession, or maybe just a slowdown. We will see. Again, we're in better shape by being in the USA, but I, as someone who watches the markets and the economy, and it's all about corporate earnings as you try to figure this out, there are better ways to invest as the economy slows down. We're not early on in this economic advance. It began, 11 years ago. And so, for my view, it behooves everyone to have some high quality dividend stocks of companies that tend to do well, no matter whether you're in a very strong economy or a slowdown. Companies and businesses like beverages, pharmaceuticals, the types of companies, utilities that you need to have your lights on every day, that type of thing. And companies you are with the utility, and companies who have a culture of paying dividends. It's a great way to make our way through these more difficult times. Buying opportunities, of course, I'm a personal investor too, and I'm poising for buying opportunities. Buying opportunities will come, but we need to be patient and remember, we don't have to pick any particular day and say, oh my God, the market's down big to stay, I need to buy. After big hits like this, you have damage to the market. It takes 4 to 7 months for things to ease themselves out. You will have numerous occasions to peel in, if you will, back into the market. So thank you very much for the chance to talk to you.